All right, so good morning, guys, and you are welcome to the part 2 of our console cash flow. All right, now we started the part 1 doing the introduction and also trying to study the principles of consolidated cash flow. And so our methodology, of course, is the indirect one. So we said that you start with your profit before tax, then you look up, all right, you look up to, so what we said is this. Always start with your profit before tax. All right, profit before tax. So this is the approach. All right, start with your profit before tax. When you finish, what do? You look up. Looking up, what are you fishing out for? So you are fishing out for all non-cash items, which is depreciation, impairment, all right, some gains, some losses. Okay, all right. These are all non-cash. Then you are also looking out for non-operating activities. Non-operating activities. All right. You are using these ones to adjust the profit. All right. So you are using it to adjust it. So these are the things. So you find out depreciation. Depreciation is always deducted. So you add back. Finance cost is deducted. You add back. Investment income is added. So you deduct back. Foreign exchange gain and loss. If it is a loss, what do? You subtract. So here, what do? You add back. If it is a gain, you always add. So here, what do? You subtract back. Profit or loss on disposal, the same thing. All right. Gains on disposal of subsidiary, loss of impairment, and all those stuff. All right. So when it came to a decrease in provision is treated as an expense. So if a decrease in provision is treated as an expense, an increase in provision is treated as an expense. So if an increase in provision is treated as an expense, what do? Here you add back. A decrease is treated as an income. So here, what do? You deduct. All right. So basically, that is that. Your working capital, we learned how to do the working capital, but you don't need to create a workings for it. Not necessarily. What do? We learned last in the video 1. So for example, if you pick your inventory, you start with your balance brought down. So whatever that you had coming from last year, then the ones that you acquire, because if you acquire a subsidiary, his inventory will come to you. So acquisition. If you rather dispose, and here when we mean dispose, we are talking about you losing control. So the inventory you had wouldn't be yours anymore. So you need to subtract. Once we are finished with all these things, you compare it to your closing balance. And you see if it's an increase is an outflow. All right. So that is how you do for all your working capital, which we did in the first part of cash flow. All right. So you go through all these things. Then you look at your investing activities also. But yes, of course, we will do your normal working straight for interest and tax. All right. So that is that. So when you come to the investing, of course, when you purchase NCA, when you receive money from disposal from the NCA, the same thing from your net, the cash paid to acquire for the subsidiary is an outflow, so you deduct. But this net proceeds from the subsidiary's disposal is, in fact, these ones is the net cash paid to acquire a subsidiary. What do we mean by that? Watch this. If I am buying a subsidiary, I'm going to pay cash, so cash will go out. So that is what will happen. So cash out for purchase consideration. So if you use cash to pay, then that is it. But watch it. The subsidiary you went to go and buy, he might have some cash inside him, which you are bringing into your own. So that is what we call it the net cash flow. So you have to take your purchase consideration and compare it to your purchase consideration, which is a cash. Compare it to the cash that you are also bringing in. So the net of it can be an inflow or an outflow. All right. So that is that. So find out, because the net cash paid to acquire a subsidiary can also be an inflow. So let me just do it like this, so that students don't assume that it is always an outflow. Okay, so it can also be, it can also be an inflow. Take note of that. All right, the cash proceeds from subsidiary disposal. All right. So that one too, the same thing. You are disposing. The subsidiary that you are disposing, was there cash in it? So if you dispose, you will be getting a cash flow. But the subsidiary that you're also disposing, there is also cash in it. So the net of it, all right. So that one too can be an inflow or it can be an outflow. So that is that. So let me strike it in that state. All right. So be very, very careful when dealing with such scenarios. All right. Then proceeds from any government grant. Okay. So any government grant that you collect. All right. The cash paid to acquire an associate. All right. That one is a cash pay. Associate is not a consolidated person. It's an outside person. Then interest paid and interest received. So you go through this formula. I mean, it's a format. If it happens so in your question, those are what you pick. Now, we dealt with the fact that in the first video, the fact that these are the principles, all right? And in the principles, the intragroup cancellation has been done already. We look at acquisition and disposal of a subsidiary, like the way we did in our first meeting, the first part one of the video. Now, what we come here to do here is the cash. The next thing is cash pays to non-controlling interest. And cash paid to non-controlling interest, we have basically like, let me say, two cash flows in there. First one is the cash you paid to acquire the subsidiary. So that is a cash outflow. The next payment will be a dividend. So we will look at that. Then the associate two, you pay to acquire, outflow. They will give you dividend, inflow. Profit on associate is not a cash flow. Profit is not a cash flow. Take note of that. Profit is never a cash flow. All right. So those are the issues. We learned to the acquisition and disposal. Now let's talk about the cash. So when you buy the subsidiary, the money that you are using to buy the subsidiary is an outflow. That one will be in your investing activity. So if you saw it, I spoke about that. All right. So that is that. Then again, if you also dispose, you saw that. Then the dividend, okay, but the dividend in an NCI, that one is a financing activity. All right. So the one that is only the investing activity is the dividend coming from your, what do we call it? Your associate. So when you are doing it, what you need to do, and these are the cash flows also from the associate. Dividend received is from the associate. You will learn how to find that. Loan made to associate is also a cash outflow. Cash payment to acquire the associate is a cash outflow. Cash received from sale of an associate is also a cash inflow. So all these things, since it's about an associate, they will all be dealt with in the investing activity. Now watch this. If there is any foreign exchange gain or loss in the cash flow, if it is about PPE, include it in the PPE workings and also deal with it in your operating activity. All right. So, and overseas cash balances too, you have to convert it, all right, as part of your closing cash balances. You use your opening rate to convert. You use your closing rate to also convert those ones so that you add it to your opening and closing balances. Basically, that is that. All right. And any exchange gain or loss arising from that effect will be treated as part of your non-cash items. All right. So that is that. Okay. So basically, that is that. All right. So you have to take note of all these things. All right. So that is that. Now, these are your workings. I always ask that do workings 1 and workings 2 like this. So your workings 1 should be about a PPE, of course. These are it, but be careful. Whilst you are doing your workings 1, do your workings 2 alongside. Why? Because sometimes there are 2 ways of acquiring an asset. It's either you pay by cash, you buy, all right, or you lease. Okay, so those are the 2 issues. So whilst you are doing that, now watch this. If your lease balance brought down, your opening is, let's say, 10,000. Then maybe you did a new lease of, let's say, 5,000. All right, then your closing balance is, and let's say there's a lease liability payment also. All right, let's say your closing balance is 20,000. What does that mean? Then this one means that there's an additional lease of 5,000. If it had reduced to, let's say, here would have gone to, let's say, 10,000, 15 and 10 will mean that there's a lease liability that you have paid. So that one will be a lease liability payment. All right. So when it goes up, rather, it is a lease addition. And therefore, your addition here may not only be a cash, it may only also be via lease. Maybe after adding a still, there will still be a missing figure, which is your cash addition. But do those two alongside so that if there is any decrease, you know that it's a lease payment. But if there is an increase, then it means there is an additional lease you need to bring into that PPE. All right, so basically that is that. Of course, the basic cash flow tells you that disposal of PPE is in here. So when you dispose your PPE, so this is it. When you dispose your PPE, it has to go out. So basically that is that. The same for disposal of subsidiary and the same also for depreciation. All right, these things are decreasing your PPE. All right, so that is that. So that is the note I made. Note, the addition could be via what? Cash or what? Right of use. Then so you do those two alongside. You see, when it is decreasing, it is lease liability payment. When it is increasing, then it is what? An addition. So you have to be very careful about that. So you start with your lease brought down, both current and non-current. All right, then any new lease addition. All right, so like I said, it can be a lease addition or it can be what? A cash or a lease addition, which means that you need to. So let me just bring it here, that there is a possibility of what? New lease addition. There's a possibility of such. So if it is like that, then you bring it in. All right, so that is it. So be careful about these things. All right, so now if it is decreasing, then it is your lease liability payment you are saving. Immediately you finish, please let me even put this one here. Immediately you finish your workings, one, do this one, two. All right, do this one. Proceeds from disposal, all right, compared to the carrying amount, all right, will give you a profit or loss on disposal. If it is a profit, we know profits are usually added there, so you will deduct. If it is a loss, we know in operating losses are already normally deducted, so you will add back. All right, so that is that. So that is it. So you do that, you come and do your workings 3 also. All right, workings 3, which is your interest and tax. So you pick up all your interest, your finance cost. I mean, you look at your current liabilities. All right, you see it there. Balance brought down. I mean, bring in the one in the P&L, then compare it to your closing balance. Then you will see that the difference is an interest paid. So this is how you find the interest paid in the format here. This is how you find it. So here should come from your workings 3. All right, and the same also for this guy. Interest and tax payment will also come from your workings 3. All right, so that is where it will come from. Let me see. Okay, so good. No you. This one is shifted. All right, so that is that. These are how you find it too. All right, so interest tax paid is also via the same workings. So you could see clearly here, this is your tax paid workings. You bring up your tax brought down from last year, both the deferred tax and the current tax. All right, so you bring both here. So don't forget, tax is a liability account. So if there is a tax credit, you would rather put it inside a bracket. All right, so take note of that. So these are your two. So if the balance brought down can be tax credit. So please, if it is a tax credit, please, you are the one who is supposed to push it into a bracket. All right, so please, that is that. If it is a tax credit, all right, so take note of that. So it can be a tax credit. Sometimes when you are doing these formats and you give to students, you have to be very, very careful. But as I've explained to you, even the one that you acquire you are bringing in from your subsidiary can also be a tax credit. All right, so take note of that. Tax is a liability account. So if it is a tax credit, please don't forget to put those ones in bracket. All right, so that is that. That is the knowledge you need to have. It's not like every tax is like this. All right, so take note of that. And the tax expense from your P&L. So like I said, if your tax coming from your P&L is a tax credit, don't put it here like that. Put it in a bracket. All right. The same thing on deferred tax on PPE, revaluation of PPE. If it is also so, I mean, that one there is not possible to get the tax credit. All right. So the difference is here. So that is that. And since this is consolidation, you might do goodwill. All right. So you have to compare goodwill at the time you acquire it and the goodwill at the time the reporting date is. The difference is any impairment. But how do you find it? Because a subsidiary may be bought, a subsidiary too may be disposed. So we know that what you do how you find goodwill: cost, purchase consideration, fair value of NCI at acquisition, fair value of the net asset. You know that is what you do if you own your goodwill at acquisition. But what if there is a disposal? Then it means that you also need to dispose that part. So, I mean, you need the goodwill as at the time of your investment. That is one. You need, like what I'm trying to say is that you need the goodwill for an acquisition. Then you need the goodwill also at disposal, and you know how to deal with these things because we have done changes in group structure. All right, so that is that. So the goodwill must leave. So you realize that normally what do you do? NCI purchase consideration, that one will be going. The NCI to our disposal will be going. From everything that you have had up to the disposal time will be going. NCI share, so those ones will be going. So basically, this place must look like this. So after that, then you compare the goodwill at brought down, goodwill coming in, goodwill disposal. You compare it to your goodwill brought down, you get your impairment. So that's how you can find the impairment to your operating activity where you are going to add back. All right. Now the workings for, like always, your workings for should be, so your workings 3, I've said that should be your interest and tax, right? Interest and tax. So you do both. Then your workings 4 should be about dividend. Now the dividend payments, so we have dividend in associate. So the dividend you do an associate. So for associate, you will be receiving the dividend. Then we have the NCI. That one you will be paying because you bought the company. The part that you didn't pay, you have to pay out. You didn't buy, you have to pay out to the NCI portion. Then dividend also from your group retained earnings. All right. So the parent. So that is that. So these are your workings for. These 3 things will form your workings for. All right. How do you do the dividend in associate? This is it. From associate, you take the balance brought down in the balance sheet. The share of profit you add because it increases your investment there. All right. If there is any OCI2 in the question, you put there. And if there is the purchase of associate, so if you are buying an associate, so this one basically is your purchase consideration. So what you bought in the associate, but this is the associate. You know how you do your associate: purchase consideration, share of profit. So that is what you see here. And if there are other things inside from the OCI you bring, if you also dispose of an associate, then I mean, this is it. All right. You also dispose the associate. The associate is gone. This is not about cash flow, like you are receiving money. Proceeds from the disposal is added to your cash inflow. All right. Investing activity. But we are talking about the associate that you dispose, the carrying amount of the associate that you dispose. All right. That is that. Then we are also talking about the balance carried down here. The difference, therefore, will be a dividend received. All right. So take note of that. Take note of that. So that is that. So pick the figures where they appear in the financial statement to do your working. Then the dividend paid to NCI. So you have your NCI brought down from the balance sheet. Then I mean, the NCI that you have acquired. So that is that, the value of the NCI you have acquired. You will do a working on that shortly for these two so that you will see it. Then you will less any disposal. How do you do NCI at disposal? So you know how to do it. Fair value of NCIs at the time you acquired it. Then NCI share of post-acquisition. Now watch this. Anytime there is a disposal, you see, normally you need your fair value at net of fair value of net assets of SAP. This is what we normally do. Fair value of net assets of SAP at acquisition, right? Then we will have our balance. At reporting, we will have our balance. Then post. So whatever we have our balance, and we share between the NCI and the CI. We share using the percentage. But you see, the NCI, the subsidiary, is disposed, so it won't be there till the reporting date. So it means that the question has to give us another NCI at the time of disposal. So he has to give us another fair value of net asset at time of disposal. That's all. So that we will use that one to compare with this and share that one instead. So the question will always give you that. That is things we learned in changes in group structure. All right. Again, you see, when there is a step acquisition, it means you also have to be careful. You see, this one, it didn't get to the end, and people, dispose. So you will use this one and this one to do the sharing of the NCI portion. Now, the question is, after doing the disposal, how much interest was retained? If the interest that was retained was an associate, then you continue with the associate share of profit for associate with the remaining percentages. Then you will add it to your associate here. All right. So that is something you need to understand. And again, when there is a step acquisition, so you have this one at acquisition, then at reporting, then post acquisition. So when there is a step acquisition, it means that in between this time and the reporting date, there was a step acquisition. So it means you do share from this side using the percentages they had before. So let's say the person had 55% and he bought extra 10, went to 65%. Between this side and this side, you'll be sharing using the 55%. Then between this new one and the reporting date one, you'll be sharing at 65%. So these are the little tricks. All right. So basically, that is nothing difficult. You just have to be vigilant and you will see it. So when this one is disposed, this is where you end it. You take the net asset as disposal. So you should be given the percentage. Then the net asset at acquisition. We will take a little example on that and you will see. All right. So basically, so that is how you do the NCI, find the NCI dividend, of course, then the parent. All right. As for these ones, we've dealt with it. All right, and this is your movement. So any issue of debt too, repayment of debt is an outflow. We did this question, so let's pick this one out to do. It's as simple. So we are finding out the dividend for the non-controlling interest. So just the format that you saw. All right, just the format that you saw. This one. This is it. So now, what do we do? So we are told that there is an NCI. So what do we do? This is it. This is the extract. They bought 70% of CC, and when they bought using full goodwill method, when they bought, the NCI is 60,000. All right, at acquisition was 60,000. During the year, they disposed of 60% in TT. At acquisition, the TT's fair value of NCI and its net asset was, so the net asset was this 70. So what was it at the time we were disposing? This is it. So that is what you go through and do. So for example, you pick up your NCI brought down from last year. What is the NCI from last year? This is so that is 690. And our carry down is 720, 780. So that is what we are doing. And they bought someone. So that person they bought 70% of the person. All right. And its fair value is, so what normally do you do? What do you do normally? You know that normally what you do is that you take your NCI at acquisition. All right. So when they acquired, this is it, fair value of NCI at acquisition. So a new subsidiary, NCI at acquisition of CC is 60. All right. 60,000 because there are 3 zeros here. That is that. And when you do NCI at acquisition, what do you normally do in your workings for? It's not share of NCI, share of post-act, NCI share of post-act or post-acquisition. And this will be found in the SPL. So the profit attributable to the NCI for 2017, 120. So that is what you do. The only thing that has come in new year is the balance brought down. And we are going to compare it with our balance carried down. So this is normally what we do. And if there were impairment, you would have deducted the impairment from this, a share of the impairment. You would have done that. But if there is a disposer and whoever it was, you dispose 60, so you definitely lose control. So what do you do? NCI at disposer. All right. So how do you find NCI at disposal? You find the NCI at that person's acquisition. Don't forget, we did this thing in changes in group structure. And how much is that? 35. When they acquired it, it was 35. Then we are going to take out a share. So NCI share or post-acquisition of that particular person. We will need the NCI at reporting. All right, so fair value of net asset at reporting minus the acquisition so that we get post-acquisition. But at reporting won't happen because the entity was sold midway. So you just be looking at the fair value at the time they dispose it. At the time they dispose it is this 100,000, and the what do we call it? And this is it. The NCI at acquisition is what? 70,000. Then you is 70,000. So then you multiply it by the NCI share, which is 40% at this time. Is that not it? Yes, because whatever percentage you had, you sold off, all right, which is like 40%. So if you do this, then you find it. That's all. Now, so that is 30. So 0.4 times 30. 0.4 times 30. That is 12. That is it. So together, what we are lessing is 47. So we take out that NCI out. We take it out. Our balance carried down is supposed to be how much? It's supposed to be 780. So 780. So now what will be the dividend paid? So this is how you find dividend paid. So how much would that be? So I had 690 plus 60 plus 120 minus 47, right? That is 600, and I have 823 minus 780. What I'm having here is 43. So this is how I find my dividend paid. All right. So that is that. And this will go to my financing activities as an outflow. All right. So that is that. That's all. That's all. That's all. All right. And this NCI, you see the NCI, if they acquired, you saw the 60 from acquisition, the share of profit, which you pick from the SPL. If this part is not in the question, it will end here, 780. Then you compare. So that is how you do everything. All right. It's as simple as that. All right. And this one too, it says that we have an associate. And how do you do the dividend findings from the associate? The relevant cash flow to be included. Of course, relevant cash flows, we learned that there are 4 relevant cash flows in an associate. So in this case, we need to shine our eye and talk about such. So watch this. All right, so let's wrap up with how we do that part of the associate. So in the question 3, what you find out is that we've been given the information. How do you do the NCI the dividend in associates and the cash flows to associates. So how do you find the dividend? We have associates brought down. So we have the investment in associate brought down will be 456. Then share of profit. Share of profit. The share of profit of associate was 48. We add that. All right. So that is that. Then we have our closing balance. Closing balance. Balance carried down. That one gives us 466. 466. All right. All right. So what will be the difference? So let's find out the difference. Where's my calculator? All right. So I have 456 plus 48 minus 466. That gives me a dividend paid of 38. So what you should understand is that this one is going to investing activities. All right. So that is that. But the proceeds for the purchase of the associate would also go, purchase consideration will also go to outflow investing activity. I don't think we have that one here. So here we've used these figures. So the loan, last year it was 300, this year is 380. So it means there is an inflow. All right. So loan to the associate. So that one will be an outflow, sorry, to the associate. So that is that. It's 380 minus 300. So that is the cash flow. So that is how you find the cash flows to this side. All right. So basically that is that. Never treat a share of profit as a cash flow. All right. So that is that. So in the next part, we take a full question and we deal with it. Thank you so much and God bless you. Have a great day. Bye-bye.